In this video, I'll be breaking down the key takeaways from Google's Q3 earnings report, zooming in on the critical info you might have missed, and most importantly, showing you exactly how this impacts your portfolio. Is this stock a buy right now, or is it time to cash out your profits? Well, Alphabet's stock has gone on an absolute tear this year, up by over 45%. It's not just the best performer among the Mag 7. It's a massive comeback story that has left every skeptic scratching their heads. I mean, just a year ago, the narrative was dark. Google was getting crushed by OpenAI, facing an existential threat to its core search business. Yet, here we are. Google has transformed from a company fighting for survival into what we believe is the ultimate player in the AI landscape, sending its valuation soaring from 21 times earnings to a rich 27 times PE ratio. Now, with Google's earnings beating expectations, revenues have topped the 100 billion mark for the first time in history. The real question is, how did they pull this off? Does Google's rumored ecosystem moat really run that deep? We've got a lot to cover, so let's get right to it. Let's start with the Q3 earnings report itself. What makes this quarter stand out? For the first time ever, total revenues exceeded $100 billion, marking a solid 16% year-over-year increase. On the bottom line, earnings per share absolutely exploded, jumping 35% to reach $2.87. What's even more impressive is that they managed to do this while essentially operating with one hand tied behind their back. The quarter included a crushing $3.5 billion antitrust fine from the European Commission. If you strip out that massive penalty, Google's operating margin would have been significantly higher and the stock likely would have soared even higher. Now let's look at the cash cows. First, search advertising revenue grew by a very healthy 15%. This completely silences the experts who warned that AI would cannibalize advertising dollars. Instead, the introduction of AI overviews and new AI-driven ad formats actually increased ad inventory. Second, YouTube advertising also saw a 15% growth, with short-form video ads, or shorts, surging by 50%. This growth rate is absolutely on a rocket ship. Third, the Google Network segment, which handles third-party website ads, showed a slight decline of 2.6%. But this isn't bad news. It's actually an extremely clever strategic move. Google's new AI features are intercepting traffic that previously went to third-party sites, effectively redirecting that advertising revenue back into its own pockets, primarily search and YouTube. This is the definition of keeping all the profits within its own ecosystem. As for the most subtle and brilliant move, Google launched new search features like a one-click collab-sponsored results button. This allows users to hide text ads they don't want to see. This strategy masterfully appeases their advertising partners while simultaneously protecting the user experience and maintaining traffic. It's truly a case of Google having it both ways. Do you think this traffic interception strategy will allow Google to dominate the ad world for another decade? Let us know your thoughts in the comment section below. Next, let's talk about Google's ultimate secret weapon, buried deep within its cloud business. It's the infrastructure that even their biggest competitors are paying to use. Many investors are laser-focused only on AI chatbots, but Google's actual competitive moat lies in its masterful vertical integration. Google owns the entire stack, from mature applications like YouTube, Maps, Drive, and Gmail, all the way down to the foundational Google Cloud business and the TPU chips that power it all. Speaking of cloud, the revenue for Google Cloud grew 33.5% this quarter, a figure that includes their booming TPU business. TPUs are Google's self-developed AI chips, and their growing adoption is directly driving cloud profitability higher. What this confirms is that Google isn't just building chips for internal use. They are actively selling their computing power to the outside world. The most stunning proof of this is that even their fiercest rival, OpenAI, is still relying on Google Cloud services. Can you believe that? Google is literally selling its tools to their biggest rival and profiting from the entire AI race. And here's the most important data point from the report. Google's management raised its capital expenditure, or CapEx, guidance for the year to between $91 and $93 billion. Plus, they also announced that this spending will increase dramatically in 2026. Now, this is the equivalent of a car company not only selling cars, but also manufacturing its own proprietary batteries and now announcing that it's spending trillions to build out hyperscale factories. Google is effectively on its path to dominating in AI infrastructure. But wait, if Google is dropping close to $100 billion on infrastructure to build an insurmountable moat, why is Sam Altman still confidently claiming that he will disrupt the entire application industry? Next up, let's analyze Google's chances of holding off the competition with OpenAI and assess their true odds. In the long term, OpenAI remains Google's single biggest threat. Currently, ChatGPT boasts 800 million weekly active users, while Google's Gemini has 650 million monthly users. More critically, OpenAI is aggressively building collaborative ecosystems with major enterprise players like Shopify and Walmart, aiming to reduce their reliance on the traditional Google ecosystem. Furthermore, Sam Altman's stated goal is to completely disrupt the entire app industry. We anticipate that OpenAI may introduce its own advertising tools within the next 1 to 2 years, directly competing for Google's launch. On the other hand, Google has two massive strategic plays up its sleeve. First, the distribution monopoly in web browsers. Take OpenAI's new Atlas browser, for example. User reception has been lukewarm at best because the underlying foundation is still Chrome, which commands a massive 70% market share globally. Chrome is the core pillar supporting Google's search dominance, and the fact that the U.S. Department of Justice did not demand Google's spin-off Chrome is a monumental victory for the company. Second, the Apple protection money. Google pays Apple a massive fee, known as traffic acquisition costs, or TAC, every year. This payment secures Google's position as the default search engine on every single iPhone. In doing so, Google controls the distribution channels on both major mobile operating systems, its own Android system and Apple's iOS system. What this all boils down to is that Google's AI product does not need to be functionally superior to ChatGPT. Google only needs to release an AI product that is good enough to leverage its massive, entrenched ecosystem and distribution network. Then, they can just sit back and watch the traffic roll in. But of course, the risks aren't completely gone. The crucial partnership agreement between Google and Apple is set to expire in 2026. Whether Google can retain its default search engine status on the iPhone remains a major, unresolved question. Moreover, the cloud computing sector is another fierce ground. New players like Oracle, CoreWeave, and Alibaba have entered the ring, and competition is heating up against existing cloud giants, AWS and Azure. Google constantly risks losing development momentum and market share here. So, tell me, do you believe Google's ecosystem moat is strong enough to withstand the groundbreaking technological threat posed by OpenAI? Let us know in the comment section. Finally, let's address the question everyone wants the answer to. Is there still room for growth in the stock, and how high can the share price go? My answer is an absolute yes. In fact, we see a realistic upside of an additional 15%. The core logic is simple. Google's Q3 report didn't just beat expectations. It signaled that its core business is incredibly, almost ridiculously, solid. Its powerful ecosystem and vertical integration are the strongest defense mechanism against the existential threat of AI disruption. Now, let's talk valuation. Currently, Google trades at around 28 times earnings. That might seem unremarkable, just around its historical average. But you would be wrong to think that. With Google dropping close to $100 billion on infrastructure and aggressively moving to an AI-native architecture, its valuation needs a complete re-rating. The reason is simple. Google has one of the healthiest financial profiles in the industry. Its long-term earnings and cash flow are steady as a rock. Unlike competitors that are burning cash for short-term growth, Google is not a speculative stock. It simply cannot be compared to companies whose ability to profit in a few years is still a massive unknown. Therefore, we believe Google's valuation multiple should be re-rated to between 33 and 35 times earnings. That translates to a target stock price approaching $300 per share. Compared to the current stock price, that is an upside of 15%. The long-term investment certainty for Google is extremely high. Any pullback from here, in our view, is simply a fantastic opportunity to position yourself in the ultimate AI player. So, do you agree that Google's stock can hit our $300 price target within the next year? Let us know your prediction in the comments below. If you found this deep dive into Google's strategy and valuation helpful, please remember to hit that like button and share this with a friend who might appreciate this analysis. Subscribe to TradingKey and click the notification bell. In our next episode, we'll be focusing on the latest earnings report from another tech titan. You won't want to miss it. We'll see you in the next one.